I was pulling up the COMEX registered silver data about 3 hours ago, and something made me stop cold. 33 million ounces gone from the vaults in a matter of weeks. Not transferred, not reclassified, gone. And silver just blew past $95 an ounce. If you're watching this, you're probably already holding physical. You've been stacking, you've been waiting. And now you're wondering if what we're seeing is the beginning of what we've been talking about for years, or just another head fake before the banks step in and crush momentum like they always do. I'm not here to sell you hope or fear. I've been trading commodities for over a decade, and I shifted to this format because it lets me get information out faster than writing articles or waiting for podcast schedules. What I'm about to walk you through is what I'm seeing in the data right now, what it means mechanically, and what I'm personally planning to do in the next 72 hours. Let's start with the number that matters. 33 million ounces of registered silver have left COMEX vaults since late December. Registered silver is the inventory that's actually available for delivery against futures contracts. It's the real ammunition in the system. When that number drops, it doesn't just tighten supply. It calls into question whether the exchange can even function as a price discovery mechanism anymore. 3 hours ago, registered silver sat at roughly 28 million ounces. For context, back in early December, we were sitting above 60 million. That's a 53% drawdown in 6 weeks. And here's the part that should make you pay attention. The price didn't drift up slowly, it exploded. We went from $81 at the start of January to $95 as of this afternoon. That's a 17% move in 3 weeks in a market that's supposed to be stable, industrial, and quote-unquote not like gold. This isn't normal volatility. This is what happens when the physical market and the paper market start to separate. Let me explain what's actually happening here, because if you don't understand the mechanics, you won't know whether to hold, add, or just sit tight and watch. The COMEX is a futures exchange. Most of the contracts traded there are never intended for delivery. They're cash settled. Speculators, hedgers, and algorithmic traders buy and sell contracts to profit from price swings or manage risk. Physical delivery is the exception, not the rule. But the whole system only works if there's enough physical metal in the vaults to back up the contracts that do stand for delivery. That metal is called registered inventory. It's been assayed, it's been verified, and it's sitting in a vault waiting to be claimed. When registered inventory falls, the exchange has less buffer, and when it falls this fast, it suggests that someone, or more likely several large someones, are taking delivery and walking away with the metal. So where's it going? I don't have vault surveillance, but I can read the footprints. We've seen huge inflows into silver ETFs in Europe and North America over the last month. PSLV added over 8 million ounces in January alone. That's metal that has to come from somewhere. We've also seen reports, and I'm pulling this from Bloomberg terminal chatter and some dealer networks I have access to, that sovereigns in Asia have been quietly accumulating. Not through public announcements, through private transactions that don't hit the headlines until weeks later. And then there's industrial demand. Solar panel production is up year over year. EV manufacturers are eating through silver for battery contacts and charging infrastructure. This isn't speculative demand. This is stuff that gets used and never comes back to the market. When you combine financial demand, sovereign accumulation, and industrial consumption, and you layer that on top of a COMEX system that was already running on fumes, you get what we're seeing now, a supply shock that the paper market can't suppress anymore. Now let's talk about what $95 actually means. Silver hasn't been this high since early 2011. Back then, we hit $49 and change before the CME stepped in with margin hikes that crushed the rally in a matter of days. A lot of stackers got burned. A lot of people swore off silver entirely. But the setup then was different. In 2011, registered inventory was still relatively healthy. The Hunt brothers' ghost still haunted the market, and the exchange had credibility when it said it was protecting market integrity. Today, the inventory is collapsing, the industrial case is stronger, and the macro backdrop has central banks buying gold at record rates while fiat currency trust is eroding across the board. $95 isn't a speculative mania, it's a repricing based on scarcity. Here's what I'm watching to see if this holds or breaks. First, I'm watching the eligible to register conversions. Eligible silver is metal sitting in COMEX vaults that hasn't been earmarked for delivery. It's owned by someone, but it's not available to settle contracts unless the owner decides to convert it to registered. If we start seeing large conversions from eligible to registered, that tells me the market is scrambling to refill the delivery pipeline. That's a bullish signal short term, but it also means the system is under pressure. If we don't see those conversions, and registered keeps draining, then we're in uncharted territory. That's when the exchange starts facing existential questions about whether it can continue to function. Second, I'm watching open interest in the March contract. March is the next big delivery month. If open interest stays elevated going into first notice day, and if we see a higher than normal percentage of contracts standing for delivery, that's confirmation that this isn't just a paper game anymore. People want metal, not cash settlement. Third, I'm watching the spreads between spot and futures. Right now, the market is in backwardation on the front end. That means spot prices are higher than near-term futures prices. In a normal market, futures should trade at a premium to spot because of the cost of carry, storage, insurance, and financing. Backwardation signals that people want the metal now, and they're willing to pay a premium to get it immediately rather than waiting for a future delivery. If backwardation deepens or extends further out the curve, that's a major red flag that the paper market is losing control. Fourth, I'm watching the dollar. Silver is priced in dollars. When the dollar weakens, commodities tend to rise. The DXY has been under pressure recently, and if that continues, it's going to add fuel to this move. But if the Fed pivots hawkish, or if we see a flight to safety that props up the dollar, that could put a ceiling on silver's upside, at least temporarily. And fifth, I'm watching gold. The gold to silver ratio is sitting around 28 right now. Historically, when silver gets hot, that ratio compresses. We've seen it drop into the teens during major silver rallies. If gold holds steady or climbs and silver keeps ripping, that ratio could collapse further. That would confirm that this is a silver-specific supply event, not just a broad precious metals bid. Let me pull this apart a little more because there's a deeper dynamic at play that most people miss. The COMEX doesn't just set the price for futures traders, it sets the global reference price for physical silver. Dealers, mints, refiners, and industrial buyers all look to COMEX pricing when they negotiate contracts. If the COMEX loses credibility as a pricing mechanism because it can't deliver metal, the entire pricing structure fractures. We've already seen hints of this. Premiums on physical silver coins and bars have been elevated for months. American Silver Eagles are trading $4 to $6 over spot at most dealers. That's not normal. In a healthy market, premiums are $1 or $2 at most. When premiums blow out, it means the paper price and the physical price are diverging. If that divergence widens, we could see a two-tiered market. One price for paper contracts that can't be delivered, and another higher price for physical metal that actually exists. That's when things get really interesting and really messy. Now let's talk about what could stop this. The exchange has tools. They can raise margin requirements, making it more expensive to hold long positions. They can impose position limits, capping how much any single entity can control. They can change the delivery rules, making it harder to stand for physical. And in an extreme scenario, they can halt trading entirely, like they did with nickel on the London Metal Exchange in 2022. Any of those moves would kill momentum in the short term, but they would also destroy what's left of the COMEX's credibility. If you're an industrial buyer or a sovereign wealth fund and you watch the exchange change the rules mid-game to protect short sellers, are you going to trust that market the next time you need to hedge or acquire metal? Probably not. That's the paradox the exchange is facing. They can intervene and maintain short-term order, but they risk long-term irrelevance. There's also the question of who's short and how much pain they're in. We don't have perfect transparency into the positioning, but we know from the commitment of traders reports that commercials, which include bullion banks, have been net short for years. If those shorts are underwater at $95, and if they're facing delivery requests they can't fulfill, they're going to either cover or blow up. Covering means buying back contracts, which pushes the price higher. Blowing up means default, which breaks the market entirely. Neither outcome is bearish for people holding physical metal. Here's what I'm doing personally. I've been stacking for years. I have a core position that I don't trade. That metal is not for sale at 95 or 100 or 150. It's insurance. It's wealth preservation. It's the bet that fiat currency is a slow-motion train wreck and hard assets are the exit. But I also hold a trading position. Metal. I'm willing to sell if the price hits a level that makes sense for my personal situation. And right now, I'm not selling. I'm watching. If we see registered inventory stabilize and start to rebuild, and if open interest in the March contract rolls forward instead of standing for delivery, I'll take that as a sign that the pressure is easing. At that point, I might trim some of my trading position and lock in gains. But if registered keeps falling, and if we see a surge in delivery notices in March, I'm holding everything and potentially adding on any dip below $90. I'm also watching for confirmation from the gold market. If gold breaks through its recent highs and starts making new all-time records, that tells me this is a broader flight to hard assets, not just a silver squeeze. In that scenario, I'm staying long and probably rotating some gains from other positions into more metal. One more thing I'm considering. If this move extends and we start seeing real panic in the paper market, there's going to be a scramble for physical. That means premiums are going to blow out even further. Coins, bars, anything retail is going to be hard to find. I've already seen some dealers post delays on new orders. If you don't have metal yet and you're thinking about getting in, understand that buying at 95 with a $6 premium means you're paying $101 all in. That's a real number. It's not just the spot price. And if you're planning to buy, don't wait for a pullback that might not come. I've seen too many people sit on the sidelines waiting for a dip, only to watch the price run away from them. If you believe the thesis and you believe that physical metal is going to be repriced higher over the next few years, then the difference between buying at 95 and buying at 88 is not going to matter in the long run. But I'm not telling you what to do. I'm telling you what I'm seeing and how I'm thinking about it. Let's zoom out for a second and talk about the bigger picture. Silver is not just a monetary metal, it's an industrial metal. It's in your phone, your car, your solar panels, your medical equipment. Global silver mine production is roughly 830 million ounces a year. Total demand between industrial investment and jewelry is over 1 billion ounces. That's a structural deficit that's been filled by above-ground stocks and recycling. But above-ground stocks are finite, and recycling is expensive and inefficient. At some point, the market has to reprice silver higher to either incentivize more mining or ration demand. We might be at that point now. The COMEX drawdown is a symptom, not the disease. The disease is decades of underinvestment in new silver production, combined with exponential growth in industrial applications that didn't exist 20 years ago. You can't print silver. You can't create it out of thin air like a central bank creates currency. You have to dig it out of the ground, refine it, and transport it. And when the market decides it wants more silver than the system can provide, the price has to rise until demand destruction kicks in or new supply comes online. New supply takes years. Demand destruction means killing industrial growth, which no government wants. So the path of least resistance is higher prices. Now, does that mean we go straight to 150 without a pullback? No, markets don't move in straight lines. We're going to see profit taking. We're going to see short-term traders exit. We're going to see volatility. But the trend is clear, and the fundamentals support it. Here's the part that frustrates me, and it's why I'm doing this. Most of the financial media won't cover this until it's too late. They'll wait until silver hits 110 or 120, and then they'll run headlines about a silver mania and bring on analysts who haven't followed the market for years to explain what's happening. By that point, premiums will be $15 over spot, dealers will be sold out, and retail investors will be chasing a move that's already run. I'm putting this out now because the data is available now. The registered inventory numbers are public, the price is public, the open interest is public. You don't need insider access to see what's happening, you just need to look. If you're holding physical, you're already ahead of 99% of people. Let me give you one last thing to think about. If the COMEX does fracture, and if we do end up with a two-tiered market where physical trades at a significant premium to paper, what does that mean for your stack? It means the metal you're holding is worth more than the spot price suggests. It means you have an asset that can't be printed, can't be diluted, and can't be seized digitally. It means you're holding the real thing in a world that's increasingly fake. That's not hype. That's just the math. So here's my plan for the next 72 hours. I'm watching the registered inventory updates. If we see another big drop, I'm holding everything and preparing to add. I'm watching the March contract. If open interest stays elevated and delivery notices spike, I'm treating that as confirmation that the squeeze is real. I'm watching the premiums at dealers. If they blow out past $8 or $10 over spot, I'm not chasing. I'll wait for the physical market to cool down before I add to my trading stack. And I'm watching my own conviction. This is a long game. The noise day to day doesn't matter. What matters is whether the thesis is intact. And right now, the thesis has never been stronger. 33 million ounces gone. $95 an ounce. A system that's creaking under pressure. This is what we've been waiting for. The question now is whether you're ready for what comes next.